Welcome, real estate investors. Thank you so much for joining me today on this fine evening. It's 7:30 p.m. in Southern California, and I'm filming this video. We're covering a great topic. We're going to be going over part two of the Pendleton Court Apartments deal. In part one, I described the steps one and two, the first two steps of my analysis process for analyzing deals. And in part three, in part two, in this video, we're going to go over step three of that analysis, which is the full analysis. And there's already a video that covers the full analysis, but we're going to go over the full analysis of Pendleton Court Apartments. So if you haven't seen it yet, then you can check it out. And in the cards at the end of this video, I'll link the part one video so you can take a look at the preceding steps that I used analyzing deals. Before we get started, I just want to let you know that I got a little nice beer going on here. This is a Stella Artois. So if it's drinking time for you, then pull out a beer while you watch this video and drink along with me, because it's 7:30 and I'm down to drink a little bit while I do this. So I'll be drinking while I do this, and it should be relatively short, but we're going to go over everything about the full analysis. So as you can see on my screen, we have the full analysis tool that I use to analyze deals. As before, if you want a copy of this tool, then send me an email at invest@connormccarl.com, and I will send you the copy of this tool for free so you can analyze your deals with. Now, also keep in mind, analyze this tool for deal. Also, keep in mind there's a blog post that accompanies this. So if you want a written description of what we're covering, it was not going to cover absolutely everything that we're covering in this video, because this video is more in depth. But if you want a written out description, click on the link in the description below, and you can check a look at the blog post. So here we go. Before we get started, please like, comment, and subscribe. This helps you out. This helps me out. This helps the whole world out. This is how the economy is created, and your love and support is so much appreciated. So thank you so much for like, commenting, and subscribing, and it definitely makes it better for me to keep doing these videos. So here we get going. As we get started, we're going to take a look at this template. We have listed at the property name, Pendleton Court Apartments. We have number of units is 78. The vintage, which is the year it was built, in 1963. So lead paint is a concern because it's prior to 1978, which is when lead paint was outlawed in construction. We have the purchase price at $3.5 million. That's a $1.95 million asking price plus the estimated $1.5 million of renovations right around there. This is not accounting for any negotiations in the purchase price, and I'll show you at the end of the calculation, if we change the purchase price, then how our numbers change, so it could significantly impact what goes on. These are just price per square foot calculations, rentable square foot, and price, just some metrics for analyzing the property. The first line that we care about here is the gross scheduled rent. So this is how much we are actually collecting in rents. This is $739,980. If we go to this rent tab here, I've listed out how we calculate that. I have the unit mix: 2-bedroom, 1-bath, 1-bedroom, 1-bath, and 3-bedroom, 1-bath. The number of units for each of those unit mix. This is the offering memorandum rent, what was listed by the broker. This is the max rent that he suggests that you could be rented out in this area. Using rentometer.com, which is a very effective tool for figuring out the average rents, because they collect rents from a bunch of different places and people submit rents and stuff like that. So you can see how that the average rent by Rentometer is $855 dollars per month, and not the $1,000 in by the offering memorandum. So the broker is overestimating rents by significant amounts. This is the total rent per year. Per month. We got to make sure that this is, yeah, good. So this is per month. Sorry, I'm just making sure my calculations are right. Yeah, this is per month. This is the max income, just taking the number of units times the max rent. This is the rentometer income, right? And what you can see down here, this is the totals per month, and this is the annual totals right here. I'm gonna actually move this right here so it's easier to see. I'm gonna make that boom. That's fine. And then you can see that we're using our calculation this, the rental meter, because what I have found is when I did my analysis also in the local area, I went to rental meter first, but then I looked at some houses and some apartments in the local area, and pretty much everything was rented for roughly $850 per month. So the rental meter was more accurate than the offering memorandum. So I'm using that number as a conservative number. And what you want to do with income is you want to be conservative by the least amount of income. That's conservative on that end. And then expenses, you want to overdo expenses to be conservative, just to make your numbers work. And what you can see here is there's a $92,000 difference between what was the broker said in the offering memorandum and what we're saying. So this is a perfect example of calling out the broker and acting dumb and just saying, hey, I must be missing something here. Can you please help me figure out what I'm doing wrong? Because I can't seem to find the average rents that you're listed in the document. I'm seeing that the rents are $850 a month, and you're saying that they could be $1,000 to $1,150 a month. You know the market. I don't know the market. What am I missing here? Because I'm clearly doing something wrong in my analysis. And that's a nice, easy way to kind of broach the topic and figure out what's going on. Because maybe you are missing something, and maybe you don't know something that's going on that can affect your analysis, and that makes a difference. So there we have it. That's the income. We go back to our acquisition page. We have that listed here. We just have a 5% vacancy in here. Now, these are pro forma numbers because this specific property needs extensive renovations in the 78 units. There's only 6 units rented out right now at $375 per month. So this is basically nothing. This is a vacant building, shell of a building that is crumbling apart. So normally, what you don't want to buy on pro forma numbers. It's really bad to do that. Now, some investors are fine with buying on pro forma numbers. I tend to not, and the mentorship that I'm a part of tends to say don't do that. But if the deal is good enough and you can make it work, where the numbers make out, and you can withstand the major renovations, this is a heavy lifting, major repositioning play, then why not do it? If it's good numbers, you have your concessions for non-payment. This is just 3% of the gross scheduled rents as an example. That's for non-payments, total rental income there, and then effective gross income. Great. Then we have our expenses. We go through taxes. This isn't updated to be correct, so this is a little outdated. So I really should make this, something higher, which I will do later. But I want this video to correspond with the blog post and the numbers, so I'll do that later. Insurance. I got an insurance quote from an insurance broker. This is $100,000 during rehab. It will drop to about $60,000 or $70,000 after rehab and renovations. So we'll save money on insurance. So we want to make sure we're again, like estimating higher amount of expenses to be really conservative and go from there. Repairs and maintenance. This is just $300 a door. You can take a look at that. That's a good rule of thumb. Green is within rule of thumb. Red is below, and yellow is above rule of thumb. General and administrative expense, this is 2%. This would be like an asset management fee. This would be a fee going to myself as a general partner or the asset manager. And make sure you include that fee because that's something that is industry standard. This is a management fee of 5%. That's pretty standard for something this size. It can be as high as 8 or 10% for under 20 units, and generally 5% or over 20 units. But it just depends on the third party property management company that you choose. And if you're doing it in house, some people charge as low as 3%, and that's some way to make sure you get extra money in your net operating income. A marketing expense. This is $100 a door. That's just fine. Utility expense. This is actually a calculation, a percentage based on what the seller says. So if I put in $100 here, then it updates there. But I have nothing for utilities, even though this one pays water and sewer, I believe it is. We would actually bill back those costs to the tenants. So I do need to update my account, my formula to include that, and then the numbers will change. But I want to keep this fine for now. Nothing here. Total expense is $182,000. You subtract those two, total income, effective gross income minus total expenses, you get net operating income of $498,642. This is capital expenditures, escrow accounts. That's just one of the things that we have in doing that. Just keep in mind. Net operating after capital, just subtract the two. This is the debt service. We'll go over the debt service right now and look at that. So debt service, this is the 300. The purchase price is 3.5 million. That includes the roughly 2 million purchase price, the 1.5 million renovations again. And I would get a construction loan for that. And talking to my lender, we can group it together, which is the best way to do it because they would be analyzing the deal on after repair value. So it helps doing the deal that way. You could split it up and do it later, but supposedly you get better. Supposedly you get better terms if you do it together. Down payment is 25%. Then it'd be an $875,000 down payment. Mortgage is the remaining 8% is the current rate. 30 years amortized. Annual debt service is 231,000 right there. And then we'll just go over closing costs too, because they come in shortly after here. Closing costs 3%. That's standard, $100,000. Loan point cost to like a mortgage broker. That's 1%. That's pretty standard. Acquisition fee is 1 to 5% is industry standard. I have a 5% acquisition because I want to get paid more, so I put that in there. 175,000. Other closing costs down here. This we break out number of months of expenses. I have 12 months because I'm assuming the rehab is going to take a year. Based on some information I collected today, rehabs might take 24 to 36 months. So that'd be 2 or 3 years, which is not a year. And I need to get an estimate from my contractor still to verify that renovations are 1.5 million and figure out how long it's going to take. So I might update that later, which could severely impact this deal, but we're waiting to hear back from them. So we'll see what happens. Insurance escrow, I just put $30,000 in there because it's $100,000 and maybe it's a quarter of that is needed. I'm not entirely sure. I just thought that was probably being conservative. Property taxes and escrow, that's $20,000. I just did an example, just rough numbers. I have to still refine that. I have another line item for debt service carry for a year because we're going into rehab. So I want to make sure I can pay the debt service for a full year during the rehab while that's going on. So that's a full year. And the appliances, because there's no appliances in any of the units, I budgeted $1,000 for each of the units for appliances. That would include a refrigerator and a dishwasher, so $500 each, which is probably about accurate. Maybe it's a little bit more. I could probably be better about that. Maybe put $100,000 in and be a little more conservative. I'll probably do that a little bit later. Okay, so now we have going back here to debt service. We calculate the 231,000. Boom. The free cash flow or the total cash flow after debt is $244,000. That gives us that. These are the returns that we need. So cash on cash return. Now, cash on cash return, remember, is net operating income minus debt service over the total acquisition cost. So if we take a look at that, it doesn't allow me because it's locked. So D37, which is the total cash flow after debt, which is exactly what we talked about, divided by M32, which is right here, which is total acquisition cost. So it's a 14.2% cash on cash return. We're really looking for at least a 12% cash on cash return. That's an 8% to limited partners and a 4% to you as a GP. So that's a good deal. So we're over the 12%, which is great. A debt service coverage ratio of 2.06. We're looking for something over 1.6. Banks in the current lending environment are looking for a 1.2 to 1.3, and we're analyzing deals. We're much more conservative to make sure the deal goes through. So we want at least a 1.6. So that's a great deal. The cap rate is just net operating income over the purchase price of 14%, which is good. Taking a 70-30 split, which means 70% to 70% of the cash flow and equity on sale or refinance is going to limited partners and 30% is going to me as a GP. That's pretty standard. I mean, generally speaking, LPs make 50 to 75% of the deal, and I'm giving away 70%, so it's right within that ballpark. It makes our GP cash flow is $73,000 a year. And then our LP cash flow is $170,000 a year. That's a 9.92% cash on cash returns for the LPs, which is great because currently in today's marketplace, interest rates are about 5%. Bonds are doing about 5%. Investors are looking for probably around 8% again, right? That out of the 12% cash on cash, 8% goes to investors, 4% goes to you. So 9.92% is definitely meeting our mark. So that's great. Okay. Next thing we have is we have an IRR calculation. The IRR calculation is a calculation that allows you to compare all types of investments together. So that's a really simple calculation. It basically takes all of the monies that are attributed to the investment, and it does a calculation based on that and the length of time. So you subtract any monies that are paid in to the investment, and you add any monies that are paid out to the investment. So, for example, year one. The investors would pay $1.7 million. Again, this is the total acquisition cost right here. Would pay $1.7 million. So that's a negative because it's paid in. They would receive $170,000 roughly in cash flow year 2 through 5, which is shown right here. And that's just coming from this investor limited cash flow, 170 right here. And then at the sale of the property, they would receive $2.6 million. How we calculate that is assuming a 7% cap rate, you determine the value by taking the net operating income, which we have on the other page, which is net operating income of 498,000 divided by the cap rate. A 7% cap is a good market. I was talking to my CFO, experienced CFO friend. He's very familiar with this market and multifamily apartment building specifically. And he said a 7% cap rate is probably good for your calculations on sale. So divided by 7%, it gets a $7.1 million property value. You have to subtract out the loan balance that's remaining to get your equity value, which is $4.5 million. That's how much cash is generated. Closing costs, this is, I just have as a 10% closing cost. You have a 3% broker fee. You have a disposition fee of 2%, which I probably won't do because of my split. It's nice. So this is actually going to be higher when I finalize this numbers. I'm a little bit more conservative on this. And then, so then you take out that numbers and you subtract the equity value, which is the total purchase price minus the debt to get the payback minus the closing costs is how much value is distributed, and you split up based on the 70-30 split. So GP will get myself will get 1.1 million, and the LPs would get 2.6. That's where this 2.6 comes from. Now, this is just a prorated amount based on $100,000 invested. So it's all these numbers, just taking $100,000 divided by the $1.7 million. That gives you a ratio that you can use for all the numbers to figure out what the actual looks like for $100,000 invested. And generally speaking, you see that a lot in these pitch decks because people are, sometimes it's $25,000 to invest as a minimum for an LP to get into the deal, but a lot of times it's like $100,000. So you see that listed out there right there. And that just gives you the IRR calculation in Excel. Is really simple. It's just IRR, and you add up all of the different monies that are associated with it. So it's adding up all these values over the 5-year period, and it's a 20% IRR, which is pretty good. So there you have it. This is what's analyzing a Pendleton Court Apartments. It matches our criteria. Now, again, these are pro forma numbers. I still might not do this deal because, hey, this is because it's a major heavy lifting repositioning play because it has major renovations, and it's basically a shell of a unit. There's hardly any income to base the property off because there's only 6 rented out units. It's not stabilized, which means 85% or more of it's 85% or more occupied. So this is, generally speaking, some investors wouldn't look at this because it's based on pro formas, but as you can see, the numbers are really good if you can stabilize, if you can withstand that hole to do the renovations and whatnot, then it's worth it. Now, as I promised at the beginning of this video, if we change this purchase price, you can see how it affects our numbers. So let's just put it down by $250,000. Maybe we negotiated a decrease in $250K, which is probably doable. It's 3250, 123. There we go. It's 3.25 million. As you can see, we went from a 14% cash on cash to a 16%. LPs go from a 9 to 11%. IRR goes from a 20 to a 24%. That's great. Now, if we got to a 3 million, which is probably what we charge, we would want to get it for, if not less than that. Remember, this includes a 1.5 million renovation budget, so you have to subtract it out for what the purchase price is. You can see how our cash on cash goes up significantly from a 14 to a 16 to an 18%, and then goes from a 9 to 11 to a 12.76% for LPs. And then the IRR is now 28% IRR. Now we're getting to something where it's a really great investment. And if you take out these closing costs, say we only did 3% because we didn't have a disposition fee and any other closing costs, you can see how the IRR, well, that didn't do it right. What's going on here? This isn't right. This is, hold on. Oh, that's what happened because I didn't do 3%. I did 30%. So increase. So 3%. There we go. As you can see, now we have a 31% IRR, which is a great, super great investment, right? So as you modify these numbers, when you have your Excel linked correctly, it modifies all the investment, and you can see what it's doing. So there you have it. This is a full full analysis. You can take a look at this investment. It's a pretty good deal. So I might move forward with it. I might not. I might not because Memphis is a really tough area. I heard from two people already. One who lives in the area, knows the market really good, like knows the zip codes. I heard from another investor that almost had a deal back in the past in Memphis, and he was telling me some really bad stories. And basically, investors, ruined the deal because Memphis is a really tough area. You're having people, probably a lot of theft. People are probably stealing your appliances. As if you see the pictures of this property, if you go through part one of this video, I go through the pictures of the property. You'll see that that's what happened. People tore up the walls. People stole appliances, and so it definitely needs 24/7 security, which I have to put in here in my expenses. So this is not fully built out, so I have to make some minor adjustments to this, but this gives you an idea of how to analyze a property. So I hope it helps. And without, there we have it. Happy apartment hunting. Your apartment, your your apartment real your multifamily real estate expert, investment expert, Connor Scott McCarl out.